All right, episode 4 on the Path to Profitability series. Today we're going to go over fair value gaps. And you might be asking yourself, it's like, wait, aren't we going a little fast? Yes, we're going really fast because I'm not going to lie, I'm not really dealing with the bullshit of not understanding everything. But anyways, like you can go watch a different video if you want to like see more things in depth, because at the end of the day, for me, what matters the most is the following episodes, not these beginning ones. The beginning ones, like this information is out there anywhere. What matters is going to be the following episodes of, teaching you guys everything you need to know in order to win. But this is essential. So fair value gaps, let's get into it. Super simple, super basic concept. Again, we'll do all of this in the chart. So first, what are fair value gaps? They are candle formations of which we had not traded the range. So I'm just going to do right here. A fair value gap, or sorry, if you guys remember in our candlesticks video, we saw that candlesticks are this, open of price and close of price that could be high and low, which reaches tradable areas, which are the wicks, right? You remember that from the candlesticks video? I hope so. Now, fair value gaps are super simple. It's this range that you can see right here that has not been traded. So if you take a look, let's go on the brush here. This whole range right here has no trading whatsoever. Price has not come into this range within the first two candles, meaning that there is a gap, so a fair value gap of, orders that weren't completely filled within that range. What does this mean? This means that this area, essentially what it did is, think about it this way. So imagine that you have two ranges, right? From, let's go into the hourly and look at the gaps, for example. Let's say right here, right? You're selling apples. You start selling apples at 8 in the morning, and your price for an apple is $25,149. Perfect. We go all the way up to $25,165. Boom, perfect. Then at 9 a.m., the price of apples skyrockets. The problem is it's moving so fast that the people who wanted to buy apples at $25,196 weren't able to. So their order and them screaming is like, hey, I want apples at this price, is still there. It's still here. But, and after, when we close the candle and we open the next hour, we couldn't even fill the orders down, meaning that this whole range right here, there's a lot of demand. There's so much demand on this range because we just skipped through it. Essentially skipped through it and we didn't trade fairly into that price. If you see, usually what candles do, they trade fairly. They try to get everybody's orders. Remember, this is a game of filling orders. The algorithm is made to fill everybody's orders as fairly and as well as possible. When you cannot do that, that's when you have this fair value gap, right? And what this means is that once price comes back into here, and think about it like this. Imagine again, we're in the apple scenario. All these people right here couldn't buy their apples. Don't you think that if price comes right back down into here, that we would expect all these people to be like, oh my God, my price is getting hit. I'm buying. Boom. We have a bullish reaction. Price of apples goes right back up. That's the concept of fair value gaps. This is obviously a bullish fair value gap. And then the bearish fair value gap would be the same thing in the opposite. So remember, going back to what they mean and what they are. It's a 3 candle formation. It has to be 3 candles. No more, no less, where the middle candle has a range of which has not been traded. Therefore, that means that price did not reach into that area. Okay? It's super simple. And what do? I mark it out with rectangles. It's the easiest thing. So I mark it out from the very bottom to the very top. This is a fair value gap right here. This whole shaded range, this is your price range where you can expect price to go higher, because we had so many buy orders here that price just ran through that whole range without wanting to trade, and it continued running through that whole range without wanting to trade into it. Okay? Now let's try to find a bearish gap. And I can just scroll back wherever there's bearish gaps everywhere. Right here, boom, look at this. And here's our following concept, which I'm going to teach you guys right now. Here's a bearish gap. What happens? Price is trading fairly at this range. Boom, we go down. We go down so aggressively that all the orders that were in this range right here could not be filled appropriately. Not that they weren't filled at all. They weren't filled appropriately. They weren't filled fairly. That's what's called fair value gap. Therefore, we can expect price, if it comes back into here, if price comes back into here, we can expect all these sellers that weren't filled at the original price to start selling once their prices hit. So we can expect some selling pressure out of this. Every time we go back up, selling pressure out of this. And this drives price lower, which allows us to get better entries. And it also is an extra confluence for our strategy. That's the whole point for value gaps. It's not just to see them. It's because it's the market telling us, hey, if we're within this range, expect us to react on the, like, you react lower or react higher, depending if it's bullish or bearish. That's the whole point of having them. Okay? So remember, again, the range, 3 candles. It could be up or down. Doesn't matter, where the range was not traded fairly, where the wicks of the other 2 candles are not touching and it leaves a gap. A gap which we use because we can expect price to react off of it. Here's a perfect example. I'll show you guys right here. Here's a perfect example. So what happens here? Price is trading, boom, we go down. Nobody's orders get filled, not fairly. There's a huge gap. Let's mark this gap out to keep it in mind. What happens? Okay, we have this very large gap right here. I'll mark it all the way here. We have this very large gap from all the way up here to all the way down here. What does this mean? That if we see price go back up into this gap, we can expect it to go lower. So what happens? Price comes back into this gap because the algo wants to fill the orders of the people that were here. And since the sell pressure is so strong, we, tap into this fair value gap and then see continuations lower. So what happens? Boom, lower, lower, lower. Just like that, okay? So that's basically it. Like, I'm not gonna keep bullshitting you guys with like more and more things. That's what fair value gaps are. Those 3 candle patterns that you can expect price to react off of, okay? So now that you've understood fair value gaps, what we're gonna go is inverse fair value gaps, which is something that I personally really like to use, but not for my entries, but just to confirm my direction. So again, inverse fair value gaps are when your fair value gap is inverted, meaning that this whole range that was supposed to give you, either buying or selling pressure is completely disrespected, meaning that the orders are no longer there and that we want to continue in the other direction. Again, perfect illustration of it right here. So as we can see, and I guess before we go into this example, because this is stacked, I'm going to go over a different example that I guess could be better. So let's try to find a different example here on the, I guess I'll go to the 5 minute because like we're more likely to find something there. So let's go to the 5 minute. Let's go like over here. It's probably something over here. So what, let's see. Perfect. There's one right here. Yeah, right here. Okay. Well, I guess it didn't quite close under it because it has to, well, we'll use this as an example. So right here, let's look at this. What do we see? We see a fair value gap right here. Okay. This blue one is our fair value gap. So let's go into the replay mode so we can see what it looks like. Look, we made a fair value gap. 3 candle pattern. 1, 2, 3. Middle candle did not trade fairly into this range. So we can expect price that if it comes back into here to continue higher. What happens though? Look at this next candle. We completely run through it and we close under it. Remember, the close is really important, where we close. It's like saying, okay, I'm going to give you guys 5 minutes to make up your mind on whether you want to buy at this range or not. We don't? Oh, okay, hold on. Then we just want to go lower. So all the people that were supposed to be buying in this range are actually not buying, and we are selling now. Meaning that we can expect price to go lower after this because we're disrespecting the original direction. It's like, okay, again, apples, right? The guy's selling apples. Boom, we sold apples like crazy. We have this whole gap of people that want to buy apples at this range only that haven't been able to buy apples at this range. If price comes into here and the selling pressure is so strong, we can expect it so that we completely disregard all these orders and we just sell. We can expect price to continue lower from there. It's not a break of structure like I mentioned in the last video, but it's very close to a start of a break of structure or a confirmation of a break of structure. Okay, so that's inverse value gaps. In this case, this would be bearish inverse value gap. A bullish inverse value gap. Let's try to find one right now so I can show you guys a good example. Let me just taking a look right here. So again, we'll go in the replay mode. Select this bar. What do we have? We have a bearish fair value gap. This whole range that was not traded, you can see that this candle and this candle did not trade into this range. So what can we expect? Price to go into it and then continue lower. But what happens is the following. Price comes back up and initially look, we react. Let me go back one more bar again. Initially we react bearish out of it. Initially price goes into the gap, trades into it, and then continues lower. However, the next candle closes in the middle of the gap. Okay, that's fine. It's not a big deal. We can still expect reactions lower. However, the next candle, look, closes outside of the gap, meaning that we didn't really give a shit about all the people in here. All we cared about is going higher. So we changed. This is your inverse right here. You've inversed the gap up here. Okay? So this concept is going to be really important for our entries because it's going to be really helpful for entries. Now, let me go over a couple other examples. And again, something to note that I guess I forgot to mention in the beginning. Higher time frame fair value gaps are more important and more significant than lower time frame fair value gaps. So let's try to find an example so you guys can see what I mean. Okay? Again, first video, higher time frame is king, will always be king. The higher time frame is going to tell you where you want to go and how you want to do it. So if the lower time frame on the 1 minute is going up, but the higher time frame on the 4 hour is going down, why are you pressing buy? There's no reason for you to press buy. So let's go over an example here. Let's go to the 1 hour, right? To not stick with the 4 hour. And let's go all the way back here just to find like a random ass example. Okay, so let's see right here. I believe that there's a fair value gap. No, there's no gaps here. Here we go. Okay, perfect. We have, I guess I'm going to go over one more concept. Okay, so this is what will be called a stacked fair value gap. A stack of fair value gaps which clearly are not trading fairly because we're not seeing any retraces. So clearly this is an area where we want to react from. Okay, so this would be considered one large fair value gap because if we go to the 4 hour time frame, chances are, as you can see, it's a fair value gap. As you can see right there, clearly a fair value gap. Now, what is price telling us? Price is telling us that we want to go higher. And price is telling us that we're disrespecting this fair value gap all the time. We're pushing higher, or pushing higher, or pushing higher. We're not seeing bullish reactions. And if we want it to go down and react off of this larger fair value gap right here, then we would not be respecting these bullish fair value gaps. We would just be seeing price drilling down and not giving a fuck about these two fair value gaps right here. We would see price just like shit the bed. We see it go down instead of going up. So if it goes up after reacting off of these two bullish fair value gaps, we can assume that this larger one is going to get disrespected. Okay, but now let's get into this. What I was talking about right now is bullish. We're bullish. We're going up. Everything is telling me to go up. We're making higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and so on. Remember from the last video, break a structure. But if we go to the lower time frame here, let's look at the hourly. Oh, where'd this go? Okay, the hourly. Again, look at this. The hourly is pushing lower. Are we going to press sell here? Absolutely fucking not. We're going to wait for price to go higher or completely disrespect this. We want to see price either trade, we want to see price trade out of here and then continue lower, or trade into here and then go higher. Those are the two options that you have. That's how fair value gaps work. If you are trading them in any other way, then you're not trading them properly, okay? Again, 1 hour time frame. Let's go to the 15 minute. What happens in the 15 minute? Oh my God, where did this go? Right here. What happens in the 15 minute? Oh, wait. 15 minute inverse the 15 minute fair value gap. What? How? We're supposed to be bullish, right? Look at this. Fair value gap right here. Boom. Inversed right here. Inversed at this low right there. At this low right here. Inversed. Are we going to press sell? No, we're not going to press sell because everything else is telling us to go higher. Every single other piece of information that we have in the market is telling us to go higher. Remember, higher time frame is more important than lower time frame. And again, I'm going to go even lower. I'm going to go to the 1 minute. Let's see if we can find something here. Oh, I guess I can't even go that far back. Okay, well, let's go to the 5 minute then. I guess I went way too far back in this case. I have no idea where the gap that we've marked out is. I don't even think I can see it. Okay, well, unfortunately, it doesn't look like I can see it. But anyways, my point stands. 50 minute was bearish, but the higher time frame was bullish. And all of that, we saved ourselves a loss thanks to those fair value gaps. That's how important these are. This is that's the concept behind this. And you need to recognize also what is a strong and what is a weak fair value gap. So let's think about it like this, okay? Think about it again in a practical sense. If a fair value gap is so strong that it moves price very strongly, like very intensely, And then there's another fair value gap that moves price not so intensely. Which one is more likely to move price intensely yet again? So which one is more likely to get respected? And I'll give you guys an example right here. We have, right here, look. We have a fair value gap. We have a giant fair value gap right here. This whole ginormous thing right here. And then we also have this little thing right here. What is more likely to get respected? The big one that made price go from all the way up here to all the way down here, or the tiny little one that made price go from here to here? Of course, the bigger one. It's obvious. So yeah, we can expect price to go lower. We're not trading higher if we're seeing a bearish value gap. It's so simple. Okay? Now, moving on. What is now the next concept is, so I'm gonna make this video a little longer, but the next concept is called BPRs. What the fuck does it stand for? I have no idea. But what those are is those are price movements of which you form an inverse for value gaps, and then you inverse the inverse, essentially invalidating the move lower. So it's like a fake out, okay? And here's a good example right here. Look at this. Here's I guess this isn't such a good example because with so many, price wasn't trading really that well. On the 1 minute, there's a lot. Let's go over the trade. I believe it was, hold on, when was this trade? I believe it was this week somewhere. There was a 1 minute BPR that I saw, which led us to take a good trade. I believe it was yesterday. Yep, right here. Okay. So, what do we see? First, we see price go up like crazy. Perfect. Second, so hold on. So we mark out this whole range of fair value gaps. Clearly, price is not trading fairly within this range. What does price do? It comes down into here. But wait, look. We inversed this fair value gap right here. We inversed it, right? This is inverse. Now are we gonna go short? No, because higher time frame is telling us that we're gonna go higher, and there's so many more gaps to fill. But we form a bearish gap. And what happens? We inverse that bearish gap right here. We inverse that bearish gap right here on this high, telling us that, okay, price essentially faked us out. It said, wait, we don't care about the buyers. Let's go down. And then after that, it's like, hold on now, not yet. We don't care about the sellers. Let's go up. So it's like a double confirmation. It's like basically like a double confirmation of your trend happening. And I actually took this trade. You can see my episode, I believe from 2 days ago or like 1 day ago. I took this trade. I entered right here and I put my stops below this, the most recent low. Why? Because we don't want to be wrong in our trade direction. If I had placed my stop loss below this value gap, I would have gotten stopped out immediately. Not a good trade. I place it here because look, we're making higher highs, higher lows. We're making higher highs and then over here, higher lows. I don't want to be wrong. If we're going to make a low, I want it to be below the lowest low because then price will probably go down. And what happens? Our trade wins. Just like that. So those are the three concepts that I think that I hope I've been able to explain. Again, if I haven't been able to explain them properly, please leave a comment. Like, tell me how I can do better. If you have any questions, join the free Discord. Do it through WAP if you can. It's free. I'm not going to charge you anything, and you can see my alerts and everything. And if you can't, just add me on Discord or like send me a Discord DM, and then I can get you on the Discord with the full access and everything. But those are the three concepts that I wanted to go over today because it's just such a key concept. Fair value gaps, such a key concept. If you're able to understand how they work and logically think, it's like, wait, this kind of makes sense. This is a whole range where people want to buy like crazy or sell like crazy. So whenever we go back into the range, we probably want to do the same thing that happened the first time. Therefore, we're likely to see continuations, and this gives us entries. And then what happens? Inverse value gaps. Wait, we want to go in one direction? We actually don't. We want to flip that direction. Therefore, that means, oh, we must go in that direction now. But wait a minute, there's a third one, a BPR. We want to go up? No, we inverse that. We want to go down. But wait a minute, that was actually a fake out. That didn't make any sense. We actually want to go up, and you're confirming that. That's like kind of how it works. Obviously, with experience, you'll see how much, like, you'll see that it makes more sense, and you'll see how price every single time we disrespect a BPR, it goes up or it goes down depending on the direction. So make sure you learn these concepts properly. I want you to go and I want you to mark out every fucking fair value gap that you see. Okay? You go to 9:30 a.m. and you mark out every single fair value gap. And you go to the 5-minute, you go to the 15-minute, you go to the 30-minute, you go to the hourly, you go to the 4-hour. And never forget, a 4-hour gap is so much stronger than a 1-minute gap. So don't trade against the 4-hour gap. Trade with the 4-hour gap. That is the best trade you can take. If your 4-hour aligns with your 1-hour, aligns with your 15-minute, aligns with your 5-minute, aligns with your 1-minute, you have a guaranteed win. I guarantee it. Okay? That's it for today. A little bit of a longer video just for value gaps. Next episode is going to be on liquidity and sweeps of liquidity. So stay tuned for that. All right? Peace out.